welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, or you can find my blogs on ospreystrategic.com as well as StockCharts.com. So today I want to talk about how a bear market wears everyone out, and it's a pretty interesting time right here, March the 8th, 2023, and it'll be very, looking back in a year, it'll be really interesting to see how it all worked out. But this is one of those date stamp days that I think is critically important. So I want to talk specifically about if you're a fundamental investor and you understand how to invest fundamentally, and you might wonder, how do these technicians do it? Well, we're at one of those indecision points, or one of the, actually not indecision points, but one of the points where the market could literally turn either way, and it's literally a fork in the road. And so what I want to show is how that looks technically, and hopefully help explain, even for somebody who's a fundamental investor, how critically important it is where we are on the charts. And so I want to go through the bull case, the bear case, and just explain that the markets are tricky here with the reversal Monday, Tuesday, wiping out the gains of last week. So it's a real interesting spot that we're at, and so that's what I want to cover off today. If you have any interest in the service that we offer at Osprey Strategic, head on over. For just $7, you can try out anything we have on the site, and hopefully that helps you. And then I'll also be doing a presentation explaining how we work through the market each week, and the types of signals we generate, and how that can help you invest, and hopefully you'll find it helpful. Okay, so with that, I'm going to jump over into the charts. And what I want to show, first of all, this is a monthly chart. And so when we use a monthly chart, what are we trying to present? We are trying to present the really big picture. And so if you're a fundamental investor, this might look Greek to you, but let me be really simple. In the 2008-2009 bear market, the full stochastic on a weekly chart went below this center line and stayed down there for almost 2 years. And then we've been in a big bull market, and now we've dipped down there. So we're clearly in some sort of a big bear market. The question is, do we rise up from here? Do we fail? And then the second component of that is, okay, how would we know technically what's more likely to transpire next? And so typically what we see is, in a big bull market, you can see that this green line has been support for almost everything really except the COVID low. And in September, October, we dipped below it, and then we bounced back above it. And we're trying to hold above that level. And that's the 40-month moving average. And then we have the 10-month moving average on this chart. And my friend Martin Pring, he likes to use the 12-month. But just pick a chart, pick a level, and you're going to work with it close enough either way. What I want to point out here is the 10-month, when we couldn't get back above it, that was a hurdle. And then in here, we went below it, and we stayed below it. And then when we finally got above it, it was a big deal. And then in 2015, 2016, we struggled in there for 6 months. And you can see we briefly got above it, but we couldn't do anything. And then in 2018, we dipped below, and again, we got back above it. And so this is kind of I'll call it a shorter term cycle. And here, whatever the drop was here, obviously, it was a more meaningful drop to get to the second half. And then what we want to be aware of is where we are now. So again, we've got lots of support. We've tried to hold above the 40-month moving average. We were below the 10-month moving average. We tried to get above on this candle. We got above on this candle briefly, then we failed on this candle, then we got above on this candle. Then last month, we closed right on it. And this month we're sitting on it. So when we look at that on the Zoom panel, you can see we keep trying to find support at this 10-month moving average. Now, if we start to break below that, again, that's where the bear markets kind of really get nasty. And so when you can't get back above, that's a problem. So we have tried for a couple of months here to hold above it. And the question is, can we do that? Now, one of the other things that we have going on here is the momentum indicator. And what this monthly momentum indicator is when you're in a big bull market, this stays up well above zero. Now, during the bull market, obviously we made this high around January 2022. We got our sell signal, and sure enough, it was a tough 12 months to follow. Now we've been riding up from October to March, and it's been an uptrend, and even last week we started to bounce off all of the averages, and so we were kind of impressed with that. And if this was to turn and bounce around zero, that would be very good for the market, and that would be something that we have seen, historically. Whenever the market tries to bounce near zero, that's a good place for us to kind of get back on a big bullish trend. The problem is in 2000 and in 2008, when we went below that, that was a pretty meaningful dip. And then obviously those were big bear markets that took longer to solve. So here's the question on the monthly chart is we're actually making the lowest level of momentum that we've made since 2011, but we haven't failed below zero yet. So it's a place on the monthly chart. Again, we're right up against both of those moving averages. We're sitting just under 4,000 here. This is recorded Tuesday night, and 39.25 is roughly the 10-month moving average, and let's call it 38.50 is the 40-month moving average. Those things are only 75 points apart, and the range so far this month in the first week has been 120 points. So we've got lots of reasons, might even be more than 100. We have lots of reasons to be very focused here on if this is going to hold or fail. And so now that we've kind of discussed it from the big picture, again, two things I want to point out. The full stochastic is in bear market mode. It's below the 50% level. And then the PPO is still in positive territory, and obviously it's had a big pullback. And the real question is, do we bounce from here and start our next leg of the bull market, or do we fail? So since the end of October, we've been making higher lows. So it's been going up for 5 months, and that's been quite bullish. Okay, let's zoom in a little bit more, and we're going to go to the weekly chart. Now, this is only a 5-year chart going back to 2018. And again, I'm using the S&P 500. I could use the NASDAQ, but the point I want to make here is that the charts are set up finely tuned for what happens next, and we really need to be aware of the difference. So in 2018, the PPO fell below the zero level marked by the black line. And as we came down here, this was pretty sharp. And then we rallied up. And when the PPO rolled over at the top here, we had a multi-month correction. And then we kind of chopped around for 6 months. We made progress and then gave it up, and made progress and gave it up. But essentially, we built a sideways consolidation roughly between 2,800 and 3,000. And then we broke out. And then we had COVID show up. And that wasn't a very good thing. Let me just turn on this focus here. There we go. So then we had the COVID thing show up. And that was obviously a problem. And it sent the chart down into the bottom half. And we spent the last year with the PPO below zero. And now the question is, are we going to start to rally from here, which would be a natural thing? We kind of get up to zero, we pause, go sideways for a little bit, kind of catch our breath, and then take back off to the upside. That would be a big bull market, right? And that's kind of what we did here coming off the 2018 lows. We rallied up for a while, pulled back, rallied up for a while, pulled back, and then got going. We've already had the rally up, pull back, the rally up, pull back. And so now, if we were going to start the next leg of the bull market, what we would like to see is a bounce off the 40-week in green, and this blue level, keep rising above it. And then what happens is once you get into a bull market, for the most part, you stay above the blue level, and that's pretty bullish. When February rolled over, we came down and we went through the blue level, but held at the green. So this is a little bit indecisive. And so again, we were on the monthly chart before. Now we're on the weekly chart. And it's even finer tuned how tight these moving averages are together. And you can see one's at 40.25 and one's at 39.25. And literally we're call it 39.85. So we're in the bottom half of that range. But the problem is we need to hold really well here. And the reason that this is so important is we have an uptrend off the lows here. And if this uptrend does not hold, and you can either use the bottom of this line and go up and say, well, we've already broken it, or you can use this closing level for that week and draw your trend line, and we're sitting right on it. So all of this adds up to, which way is this market going to break? And we don't know. And so what we're working really hard to try and figure out is, we had our bear market that was below the 40-week moving average. We're now back above it, so that's bullish. We like to be above the blue level. Well, we were, and then we pulled back, and then we were, and we pulled back. And so how is this going to resolve? And that's why it's getting so tight. Now, when we zoom out and look at a couple of things, one thing is if you're above the 40-week moving average in green, that's a pretty great place. And again, in blue, I'll call it support that gets tested way more often, the 10-week moving average or the 50-day moving average. So let's go up to one other thing, and this is the full stochastic calculation. And essentially what the calculation does is it says, what was the price range over the last 3 months, and where are we? Are we in the top third, the bottom, or the top half, but not the top, and then the bottom half, but not the bottom, or are we in the bottom? And then obviously, in this period in here, you'd be at the bottom of the 14 weeks. And here we're kind of up near the top, but as the full stochastic shows, we've run up, pulled back, ran up, pulled back. And now we're slightly lower than the prior low. And so the issue is, are we going to bounce like we did back here coming in through COVID? And this was the vaccine jump that kind of turned the market on the next leg, and we went up for almost a year after that. So what we see here is this big push up, and we made it kind of a double bottom, and we stayed above 50. Well, when we zoom out, staying above 50 just happens to be associated with market runs that are very positive, and when we dip below, those can be more meaningful. And obviously the COVID one happened, but the Fed jumped into the rescue and threw billions and trillions at it, and worldwide they did, and every government spent money and mailed money to all their citizens to try and keep things going. Where we sit right now, well, we're right at that 50% level, and are we going to hold? So that makes for another question. So we have this basically saying we're undecided. We're lower than we were, but we might still be able to bounce here. We have the moving averages very tightly packed together. The blue just crossed the green, so that's bull. But what if it doesn't hold here and we start to roll back down? And again, remember in February, we got above it, or in January, we got above it. Then in February, we got below it. Now we're sitting on it. So we're on the weekly chart, we're down to this kind of condensed, where are we now? But I will say on the weekly chart, this thrust above zero in terms of momentum is one of the weakest we've seen in a long time as you come off a major low. So let's just open the chart up, whatever, let's go 25 years just to pick a number. And what you tend to see if you just focus on here is kind of when you come out of a big bear market, usually you rally quite well. And this is one place here where we paused right around zero and then took off to the upside. But we had a big double bumper over here and we ran to the upside, and now we're breaking that upsloping trend line. But it's one of the weakest rallies in terms of elevation coming out of a big low that was down almost 5% or 4% on the chart. So as we draw our way across, obviously 2000 and 2002 did that. But in 2002, we barely got above, or we got to zero and then we failed. Well, we've been a little stronger than that, but we're starting to roll over and actually point down now. It's not the end of the week. It could turn up by the end of the week. But what we really need to see is from this big depressed low, if we're going to be entering a new bull market, this thing should kick up like dynamite and just fire off to the upside. And so for us to pause here is quite concerning, really. Just use that word concerning, not nobody says we have to start with a nice bull rush that makes it easy. So again, our hands are tied here. We're kind of in between two major themes of the bull market being above the 40-week, the bear market being below the 10-week, the full stochastic below the prior low, but still above 50. So a little bit negative, a little bit positive. And then we go to the PPO. It's up, but it started to break its trend line. It's rolling over at one of the lowest levels on a move up from below zero that we've seen in the last 25 years. So not a lot of comfort here the way the market is behaving on a weekly chart. So now let me tighten it up even more and go to the daily. So on the daily chart, there's a whole bunch of things going on here. So the orange line in this case is the 200-day moving average, which is equivalent to the 40-week moving average, which is roughly equivalent to the 10-month moving average. So when you see all of these together, the big point I want to make here is the trend was down, but now you see the moving average has gone flat, the long-term one. So that's typically positive. It finally bottoms out and then it starts to turn higher. The good news is we broke, so I'll go through the bullish case, we broke the down sloping trend line and started to rally above it. And then we pulled back and we've done what's called a back test, where you break above a trend, pull back to that same trend, typically a little bit lower than you were at before, but you pull back and then you bounce out of there and you head higher. And that's what it looked like we were going to do on Wednesday, Thursday, Friday. Well, Wednesday was a stall, Thursday turned higher, Friday higher, and then Monday kind of stalled around the 20-day moving average and started to roll back down. But for the point of discussion, we're still above this black line, so that's bullish. Now we have the 50-day moving average, and we were trying to hold above it, but we closed the day just below it. So that's a little bit of a question mark. And again, the 50-day is like the 10-week that I showed on this chart. We'll just go back to 5 years on the weekly chart. And again, that 10-week tends to be support, and you'd like to close above it on a regular basis. Well, again, now we're just below it on the weekly. And when we look at that on the daily, we're just below this gray line on the 50. So now we have an uptrend line here that we've drawn from October to March, and that's been holding. And so we tested that last week and we bounced off it, not once, but twice. We bounced off it on this red candle, and then again on this blue candle, and fired up. And now we've come back down to test it again. So it looked like we had 2 tests and it held and we were going to go and everything's fine. But in reality, we've rolled right back over now. So we're right back to where we started. And the problem we've got here is if this doesn't hold, and again, the red candles aren't very friendly on this chart when they start to break down. But more importantly, if you look farther left, if we're on the next leg of the big bear market, these red candles can extend quite a bit. So we need to be very cautious here. So again, we've got some bullish traits that we've broken above all the moving averages, trying to hold above them. And then we pulled back in February, tried to get above the 20-day moving average, failed on Monday. And then now we failed the 50 on Tuesday. And the 200-day moving average is literally just 50 points below here or something, and we could fall right through that and fall back through this black trend line. And I think if we fall that little 50 points, that marks a major turning point for us, because that means this 5-month uptrend that we had going is broken. The last uptrend we had from June to September got broken, and it also got we bounced off support of that trend line, went up, tested the 20-day moving average, and failed right at it. So here we are sitting here again, trying to do the same thing. We've got an uptrend. We get to the 20-day moving average. We fail right at it. We fall back below the 50. And how hard do we fall? So this is getting narrower and narrower and narrower. So we're down to literally 50 points on this chart, deciding if we're going to fall back below this black trend line, the 200-day moving average. The gray moving average we're already below, but maybe we can bounce here again off this trend line one more time. So we're in literally this tiny little box whatever, let's call it 39.25 to 40.25. And we're really trying to work hard to figure out which way the market wants to go. And as a technician, we really need this to break higher here if the bull market is going to continue. Now, the other thing we've got is three major peaks here that are actually still making lower highs, but we had this short rally. Well, not short, it took 5 months, but this rally made a higher low, a higher high, higher low, higher high, higher low than this one, and a higher, not a higher high than that one, but then it failed, pulled back, and then it goes on to make a higher high. So now we've got a series of kind of a bigger picture, higher highs and higher lows. We pull back to this trend line. We're still higher than the lows here, the lows here. I tell you, from a technical point of view, everything is fine-tuned to the trading range of Wednesday. It's literally that close on how this whole thing performs. Now, my real fear is if we break the uptrend from October, starting to talk more about the bearish characteristics, this is not very good for us. And we have lots of places where the market has stalled in this range between 40.25 and 41.50 over and over and over and over again. And so we're struggling. And then whenever we fail at the 20 DMA, that's a real problem. We didn't really fail in here. We got above it for a day, but then we rolled back over. But here we're clearly testing from the bottom and failing. We did this back in April. We tested a few times on the way down in May, got above it, failed below it, failed at it, pulled back, failed in here a little bit, then finally got going, pulled back. So this 20-day just happens to be a 1-month moving average, and it's causing friction as we go. Well, Friday, Monday, Tuesday friction isn't a very good picture. And so here's the point, is if all of this is going to set up and fail right here, we need to be very aware that this is kind of a critical place on the chart from both the monthly perspective, the weekly perspective, the daily perspective, and you know, we could go to the 60-minute perspective. It's at another critical place. All of this is lining up into a tight wedge. So I have a couple of indicators that I created for my clients to help see when bull markets or rallies are forming. And what happened was we were down below the 25 level and we turned back up, and this looked like a buy signal. Now in September, we had this steep turn up. It lasted 4 days and then we fell back down. And the PPO for this indicator was below zero, tried to turn up and failed and rolled down. So are we going to do that again? And if so, this was a meaningful drop in here and we started to make lower lows. Well, you can see if we draw the line over, call it 12,000 for the S&P, 12,000 for the NASDAQ in brown, and over here, 3,900 for the S&P. This has been an important level on the chart. We do not want to fail these levels as we go forward. So this indicator turned down on Tuesday after looking like it was on its way back up, starting to give us a buy signal to start to buy stocks in the market. Well, as much as I'd like to buy stocks in the market, if this thing's going to roll right back down and start the next leg of the bear market that on the monthly, on the weekly, and on the daily are at a critical point and unable to hold that, then I just have to move away and wait to see what the market wants to do. And I think it's a critical place on the chart for people to be aware of. Now I have two faster indicators, and when they get above 25, I like it. Well, what did they do on Tuesday? They pulled back below 25. Our PPO gave us a buy signal for this indicator. So that's a nice thing. But in September, it tried to do that and failed. So again, here we are. I feel like an economist. On one hand, it looks bullish, and on the other hand, we've seen this movie before, and when it fails right here, the market moves down another 10% quite quickly. And then I have one more called the SSIQ, and it didn't even jump out of the 25 level. And so it makes me even more nervous that it couldn't even get going, and these are just measured on different time frames. Okay, so why do I think the market is so critical here? I've tried to define it on multiple time frames and show how sensitive where we've got to on all the charts are. And the big thing for people who are fundamental investors is be aware of how sensitive the market is to this zone. Again, we failed here many, many times. If we don't get going here, there's a real reason for us to make a leg lower. Now, maybe we just continue this sideways chop and wear the bears out like we've been doing for a while. But more importantly, try to make sure that you have a plan that you're comfortable with. And again, I take the signals when they start to turn up and I want to be a buyer. So in my case, I'm buying the market here because it's breaking out, and then all of a sudden it starts to fail. Well, I'm going to take a small loss and make sure that I maintain my capital, because if this is the turning point and I'm going to lose whatever 1% or something of my portfolio, I'm going to take that 1% loss and I'm going to let the market move to wherever it needs to make a new low, and this indicator will start to turn up when I need to do that. If you'd like to learn more about it, feel free to join us on the presentation that I mentioned earlier. That's on March the 14th at 1 o'clock in the afternoon. And hopefully you find some value there. Thanks for taking the time to join me. Market Buzz airs at 10:30 a.m. Eastern Time on StockCharts TV, and you can also find the recordings on their YouTube page. Thanks, everybody. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.